This panel is going to focus on a very important topic, the state of the economy in a time of uncertainty. Due to a series of unprecedented geopolitical events, economic turbulence has become the norm over the past 2 years. The online trading industry has had to learn to adapt to constant change and to sink or swim in the process. Our moderator, Homos Fayyal, who is the head of institutional sales at ADSS, will introduce our speakers to you. Welcome, panelists.
Hi, everyone, and welcome to the economy panel. Today we got some great guys who are very knowledgeable in this space. I'm looking forward to this panel. I'm going to let each one very briefly introduce their companies and what they do, so we get a bit of marketing as well. Very briefly, very quickly, thank you. David, if you could start, please.
I'm David Jones from Capital.com. We are a retail, CFD and FX brokerage, and I've been in the industry for about 18 years.
Hello everyone, my name is Nicolas Shamtanis, I'm CEO of BD Swiss. We're also a CFD multi-asset broker. Our basis is here in Limassol, we operate around the world. I've been in the industry for about 17 years.
Hi everybody, we are Exclusive Capital Prime. We are also a CFD and asset manager broker. CFD broker and asset management. And we also provide a whole host of other services for the industry. And my name is George Kessarios, and I serve as the chief economist to the group.
Hello, my name is James Hughes. I'm chief market analyst at Scope Markets. We are also a CFD and multi-asset broker based here in Limassol. I think there's quite a few.
Well, that's amazing. ADSS is pretty much similar. So we just got, copies of each other right here in terms of companies. But so today we're going to talk about the economy and the impacts on us and the wider, perhaps also our industry. So I wanted to start with the Federal Reserve and the interest rates and where we're going, what happened the last year, maybe this year, year to date, and sort of kind of what do you guys think about Federal Reserve, what's happening, mistakes they've done, etc. If I start with you, David.
I think all the central banks have been too late to do anything about inflation. And they're playing catch-up now, which I think is a really dangerous situation and a difficult situation for all of us. It is with inflation rates as they are and sticking around for much longer than anybody was talking about even 6 months ago. If they'd started raising last year, they had more of a run at it. And I think the problem now is it's going to be such a fine balance between raising rates without completely screwing up the global economy and trying to keep a lid on inflation. So I think the next 6 to 18 months are going to be difficult ones for central banks after doing nothing for years. And it's going to be, I think, a really difficult one for the global economy. So it's not a job I envy, but they definitely were too complacent, all central banks, I think, in trying to keep a lid on inflation.
Okay, Nicholas, anything to add on that?
Yeah, I would like to just give a little bit of a background for our audience also to understand the relationship of interest rates together with the economy. So back to the Fed, they did raise the rates lately in March by 25 basis points, but why did they drop them in the first place to almost zero? The reason was the pandemic. The Fed, the biggest tool of any central bank is interest rates in order to revive or control the growth of the economy, to revive the economy when it's in a slump, or to control the circulation of money when the prices go up. So when COVID hit and everything stopped basically, they needed to lower interest rates to the absolute minimum in order to encourage people to spend their money. So if you or me have savings in the bank and you get absolutely zero interest rates, then you say, what I'm going to do it in the bank, I have to spend it. So the reason why the central banks do that is to encourage us and businesses to spend it in order to revive the economy. The opposite happens when inflation rises and prices go up. If they raise interest rates, then we don't have the incentive to spend the money anymore, but to keep it in the bank. So this is just to illustrate the usage of the interest rate as a tool from the central banks. Now, as David said, because of the fact that inflation spiraled out of control, central banks are playing catch up and they're raising, I think now in the US, They raised it by 25 basis points. They followed with 50 basis points in May, and the speculation that they're going to raise by another 1% until September. And their aim is to have it by 2.5% by the end of the year, which is considered, let's say, a neutral rate. But to just finish, I just want to say, yes, they made a mistake, but at the same time, not every central bank had the luxury of worrying about economics when they had to deal with a pandemic and the revival of the economy. Probably the only central bank that moved faster than anybody else was New Zealand when they hiked rates in October, but that's mainly because they were relatively unscathed by the pandemic.
Yeah. George, what's your thoughts on this?
My thoughts are that central banks were correct doing what they have done all this time. That's number one. Number two is that they were correct in saying that inflation is transitory. Problem is, what do we mean by transitory? Nobody has defined that. I still believe inflation is transitory. And I think they're making a mistake. I'm calling that they're making a policy mistake, as Powell did in 18 and 19, for different reasons. And the reason is because the inflation we have right now, currently, has nothing to do with monetary policy. It has to do with war, with supply shocks, okay, pandemic and so forth. And it has to do, like I said in Dubai, it has to do with high price of energy, which is twofold. One is because we disinvested from energy, all Western countries and markets starting 2015. And number two is, as a result, we had a lot of companies going out of business, especially in the US. And now, we had sort of a little comeback, and there's not really a lot of supply. So yeah, prices went up, but again, it had to do with Russia also, and we have a war. So these are outside the scope, in my opinion, of the central banks. And they've said that. Even the Fed has said that, and the ECB has said that. We can't do anything about the reasons that are causing this inflation. And basically what they have decided is, which is a shock to me actually, because I've never heard the Fed chairman say, okay, I think unemployment should go up. Or the Fed coming out and say, well, I think markets have to crash a little because we want to take the wealth effect out. So they're trying to make people poor, basically, in order for them to lower spending. I think that's a mistake because, the U.S. had, in 1980 when Volcker lifted rates, U.S. had 25% debt to GDP. Today, it's like, 100 something, whatever it is, in the U.S. I don't even want to talk about Greece, Italy, Spain, and other countries. And if you recall what happened in Japan about 2 months ago, is that when the bond market started selling off, they came out and said, okay, 0.25, it's not going more than that, we're going to buy everything across the board. We're not going to let interest rates go higher than that, or yields, let's say. So it's a difficult situation. I agree with what David said, but at the same time, I'm leaning towards that they're going to make a policy mistake. And
so you think that the raising of the rates is a policy mistake?
Yes.
Okay.
I think because there's a lot of things that can
it
go
low?
really, really bad, and then they're going to have to do catch up, on the other side. Okay. So
James, what do you think? Mistake?
Yeah. Obviously, I think both views are pretty valid, but I think that you need to look at why these interest rates need to be raised is because the world is being pushed again to the edge of global recession. That's something that we need to look at with the increased cost of living everywhere. As George said, the fact that these inflationary pressures are not caused by monetary policy, but what the central banks need is they need bullets in the gun to tackle the recession and the issues that will happen with the global economy when they come. With record low interest rates, there are no bullets left in the gun. There is nothing to fire when the problems really start to hit. And the cost of living is getting worse, we know that, and in many countries this is worse than in others. And if you look at the Eurozone as another factor, not yet moving rates, okay, getting close to moving rates, but not yet moving rates, change the policy, but they're most at risk to the energy crisis that's happening. They're most at risk with the war in Ukraine. So are closer to the abyss, if you like. But once these things happen, the Eurozone, unlike the Fed, unlike New Zealand, unlike in Canada, the Bank of Canada, there will be nothing to fire when the problems really do hit. And I think that's the biggest issue that we have to face here, is that when that recession hits, and for me, I think it's pretty inevitable, what can the central banks then do to tackle that problem, rather than tackling the inflation, which could well be transitory, as George says. You know, how do you then tackle the global recession that's on the back of it?
Okay, so David, in terms of inflation, how high is it? Like, it's pretty high the last 12 months. Do you guys have some numbers maybe for us in terms of inflation in historic context?
Well, it's at a 40-year high. You know, you've got to go back
to when I was born.
To the 80s, or maybe even the 70s for some countries. So it is, I think and it is interesting if you take the fact that, I mean, clearly lots of people are going to really feel the squeeze. It's interesting that no one as an adult has really lived through inflation, or none of us as adult investors and adult traders. So that's why, you know, we've seen what's happened with stock markets this year, for example. We've seen a lot of pressure on stock markets because of the unknown about, as James was saying, the potential coming recession and where interest rates are going to go. So it's you know, I suppose you could say academically, it's an interesting time to live through, because we've got to go so far back to see this. If you look at stock markets, investors have been really spoilt since the financial crisis, that basically if the stock market had a big sell-off, just put more money in and it would come back. We've had a very different market this year. So I think it makes for quite a challenging backdrop where we are now. And I think there is, again, from a market's point of view, from my point of view, this is the most uncertain I think we've been about markets since the financial crisis, because there's so much stuff that still isn't known. You know, if we went back 18 months or so, when markets were bouncing back after the initial lockdowns, we had this fantastic trajectory for all sorts of markets pushing higher. But now I think we have so much uncertainty, which for our industry, looking at it cynically, creates opportunity, because people love volatility, people love crazy markets, because they all think they can make money out of them. So, but I think from an investor's and a trader's point of view, it's a really uncertain time and some interesting times ahead.
Yeah, James, I want to go to you on this one. Has the inflation peaked, or is it very high? Like, do you think it's peaked, or it's going to go much higher?
Well, I think there's different pressures. Obviously, we're seeing inflation looking like it's peaked in the US. We're starting to see that drop off. Now, whether that's a direct result of raising interest rates or it's the transitory nature of inflation, you know, whether that's the case or not. But we are starting to see that drop away. Now, not by much. We've seen drops to maybe 8.2, 8.3%. But I think the issue is that the energy crisis isn't going anywhere. You know, the energy crisis isn't going anywhere. The war's not necessarily showing any signs of easing, even though it may not be in the news flow for much longer. It's not necessarily easing. So the pressures are there, and if inflation is coming lower, it's because the Fed in the US are acting upon it. But of course, it's that the divergence between central banks is going to be huge, and especially between the Eurozone and the Fed, because the Eurozone have yet to act. They're looking to act, but they have yet to act on this. Whether that's the right thing or not, we don't yet know. But of course, we are starting to see in the US inflation start to drop lower. In New Zealand, as George says, which was first in this move, it's starting to drop lower. But in other areas, it's not. So the worrying point there is that you'll get divergence, not just inflation, but you'll get divergence in monetary policy, and that causes its own issues going
Did you
forward.
see yesterday, I think they clocked 20.1% inflation. Was it in Estonia or somewhere like that? In EU?
Yeah, and that's where the price pressures are coming in the Eurozone especially, in Europe especially, that's where
It's shocking that they haven't raised like the Fed.
We've seen a shift this month. In May, sorry, there was a shift.
Yeah.
Christine Lagarde changed her tone. There was a number of speeches where she completely 180 with her tone, and that should have come, maybe a few months ago, but it didn't. And now the issue being is how fast can they now raise these rates to close that gap of the divergence between the major central banks and tackle the inflationary problem, and then have bullets in the gun once the recession hits.
George,
it's a real tightrope.
Are they behind EU?
The problem with, first of all, I do think that inflation has peaked or is peaking or is going to peak sooner than, the problem...
That's good news.
Let's hope. But the problem in Europe is that they cannot raise rates. They can't. Greece has 250% debt to GDP. It's number one, and it's even more than Japan. Italy is 130, 140. I don't even know where it is right now. There's a lot of debt in Europe. You cannot raise rates in the name of fighting inflation. So let's raise rates to 5 or 6%. You can't do that. Everybody's going to default. And it's the reason why I mentioned before that the Bank of Japan capped yields at 0.25%. They said whoever comes and sells, we're going to buy everything, unlimited qualities. But yields are not going to go above 0.25%. You cannot afford, anybody cannot afford, not even the US. And that's why you see markets crashed, literally, when they raised 2.5, when they said, oh, okay, we're going to do it 50 and 50. Markets cannot handle that. Or rather, the world economy cannot handle that.
So what they're threatening that they're going to raise, if they actually do, no one can handle
it. If they do, and especially if they lower the the Fed's balance sheet, they want to, unwind a lot of it. If they do that, it's going to be catastrophic, in my opinion. We're going to see. It's just. I'll just leave it there. I'm going to say it's going to be catastrophic.
I was going to cover also gold, maybe on the inflation side. Have you guys seen a bit of maybe? For me, gold is a bit surprising, right? Everyone's talking about inflation the last 12 months and like, wow, it's unbelievable. And then everyone remembers this, that you buy gold when there's inflation and gold goes up, and it hasn't.
That was a big surprise for every investor or trader, including myself, because we have been brought up to believe that that gold is the perfect inflation hedge. However, there are two factors that are very important to have in mind and that explain why this has not happened. First of all, higher interest rates also mean a much stronger dollar. And we see that right now with the dollar trading at multi-year highs, let's say, against most of the major currencies, including the dollar yen, the euro dollar. So when the dollar is higher, it makes it more expensive for people for big markets such as India and China to buy gold, because they have to exchange their domestic currency. So yes, you do see a rise in inflation, but the dollar strength is stopping its price from capitalizing. And the main reason why gold was rising in the past few years was in the period of quantitative easing, basically printing money. So we don't have that. We have exactly the opposite of that. We have a stronger dollar, and at the end of the day, gold is not an interest-bearing asset. So even if you buy gold, at the end of the day, at the end of the year, it doesn't really give you any dividends, it doesn't give you any interest rate. And in an environment where inflation is high, interest rates are high, gold is just another asset that competes on interest rates.
David, what's your thoughts on gold? I mean, if we have 20% inflation in some countries, you would have to say gold should do well. No, inflation is happening.
You'd think that, but it hasn't, has it? And I think it's really interesting what's happened this year with gold. You know, coming into this year, we had almost the perfect storm for gold. You had high inflation, which we knew about at the end of the year. And again, we've all grown up thinking, oh, gold is safe when inflation's going up. Then we had falling stock markets in January before the Russian invasion happened. So the stock markets were weak. So again, you've got inflation, falling stock markets. That should be good for gold. And then you have this massive geopolitical event where Russia invades Ukraine and we have a land war in Europe, again, classic, in times of trouble, let's dump everything and head for gold. And all gold could do was go up quickly to where it was in August 2020 and then fall back down really quick. So gold couldn't even make fresh all-time highs on all of this stuff that theoretically would be perfect for gold. And I think that's the thing. I think we've seen now, it's almost like the US dollar has taken over a big chunk of the safe haven status that gold has had historically. You know, last year was a really poor year for gold. The price of gold was down 3.5% last year when basically everything else went up. You know, if you threw a dart at anything last year and put some money in it, whether it was a commodity or some stocks, you know, the markets went up. But gold was really weak. So the fact that gold, it's up for the year to date, but it's not gone soaring away, I think tells us that perhaps that old rule of thumb, gold does well in inflation, perhaps that's going.
Perhaps that's going, yeah. I think, James, your view on that is that it's a little bit too early to count gold out, right?
I mean,
it might happen in the next 12 months.
Yeah, I mean, we could all sit there and say, yeah, it could go up. I mean, of course, you know, that's the situation that we're in. But markets have been you've had such strange performances in markets. I mean, the guys have all just said, you know, that inflation gold hedge isn't working. You know, so as traders, what do? You have to shift. You know, you have to shift away. Sometimes, I mean, we've all been in situations as traders where we've done something and it hasn't worked, right? So it's the same situation. If we strip it away, we can look at it from an economic standpoint. But to look at it from a trading standpoint, it's just a trade that didn't work, right? So you diversify. You look at something else. There's always something else that has those movements. You look at oil prices. You look at some of these commodity-based currencies and economies, like Canada, for example. In a perfect storm of, if you look at the Canadian dollar, the Canadian economy was incredibly strong. You know, the being a commodity-based currency, the rise in oil price was positive for the currency. Then of course seeing in the rates moving higher, that was positive for the currency. So Canada, to a certain degree, has a completely, you know, separate, and a lot of these commodity currencies have a completely separate microcosm of the market, you know, where things are slightly different. So yeah, gold has struggled. The safe haven aspect of gold has been pretty old-fashioned for quite a long time, really. You know, over the last few years or so, it's been pretty old-fashioned, that the fact that you can just shift to gold in times of economic strife as that safe haven is something we used to talk about 20 odd years ago, 15 years ago. So, I mean, there are other asset classes, there are other things to move into, and of course, we know that, as David said, the last year or so, throw a dart at the market, buy it, and sit there and hold it, and you're quite happy. But of course, market shifts, market changes, and the one thing we all know is markets don't do what you want them to do all the time.
Yeah.
Yeah. I just want to add to that. Intermarket relationships work until they don't anymore. I think that's what has happened with gold. And furthermore with gold, like everybody said, we grew up thinking that, or knowing that, gold is an inflation hedge. Well, if gold did not go up now with inflation, 40-year inflation, and if it did not go up on the verge of, let's say, World War III, when the hell is it going to go up? You know, that's the reason. So that's the question. And I think, like everybody said, you know, that relationship is could go up, yeah. It might surprise us, and next year we might see it by $1,000 up, sure. But I think it's probably safe to say right now that whatever the intermarket relation with gold was many years ago is just not there anymore.
I think we can say quite easily that we will agree that markets can go up and they can go down. I think that's the end part to that. It could go up, it could go down.
Yeah. Now, that's a good one, huh? It could go up and it could go down.
That's what I tell my clients.
It's worked for me for 20 years, so it could go up, it could go down.
In Greece, we say if it doesn't rain, it's going to shine.
So, assuming the interest rates are going to increase a little bit here, 1.5%, we're going to have inflation at these rates, maybe it comes down a little bit. What would you invest in? I mean, so I think some of you guys were saying that, look, there's so much bad news. I think was it you, George? Was, you know, like, there's so much bad news that if you get a couple of good news, like peace in between Russia and Ukraine, a couple of good news would just make this thing go super high. Like stocks would go crazy high. Maybe not. Maybe the market's priced in everything. But like, so there's so much bad news that if some good news comes in, like, what would you invest in? What would you recommend? Well, not recommend. What's your hunch in terms of what would you want to be long and buy and own, assuming interest rates are going to go higher? Would you want to have a property in London and UK? You know, what would you invest in? What would you be long?
I think if it comes to financial markets, for me, I think that the dollar, I'd still be, a buyer on dips of the US dollar, because this uncertainty isn't going away anytime soon. It has hit, as we've heard, multi-year highs, 20-year high dollar yen. The dollar index is an interesting market. The dollar against a basket of different currencies, that's an 18-year high. So for me, absolutely be a buyer of dips of the US dollar. Stock markets are difficult because even before Russia invaded Ukraine, stock markets were falling. Some of these glamour, high-tech growth stocks, the metaverses, the Netflixes, the Teslas, they were all getting hit really hard. So investors were definitely worried about valuations before Russia invaded Ukraine. So I think if there is any sort of resolution there, which there doesn't look like it's going to be anytime soon, I don't think it's taken for granted that stocks are going to bounce back. So I think it's going to still be a really difficult year. And for me, the obvious one is the dollar. And maybe, oil. I mean, it's ridiculous how high oil is.
I was going to say ruble,
yeah.
But you said oil. Similar.
Yeah, so it's gone from $10 two years ago to $120 today for a barrel of oil. I think it needs a bit of a shakeout in oil, but again, if we saw a big dip in oil, I'd be quite keen to be a buyer. But everything else, I think, is still going to be perhaps, massively volatile, but ultimately directionless for a bit when it comes to stock markets until we have a better view of what the world economy actually looks like.
Yeah, Nicholas, what would you go long?
First of all, I need to say my compliance officer is here, so this is
So
not
we'll
investment
go to
advice.
George.
This is not investment advice, but I agree with everything that David said. I think an interesting play when it comes to the currency markets, because he touched upon it, I think the most interesting play here is the so-called carry trade. Carry trade is when you borrow a country's currencies that doesn't have almost zero interest rates, in this case Japan, and buy something that has high interest rates with a potential to go even higher. And that is most commonly
Turkish lira.
Turkish lira, but also the dollar yen is the most, or the yen pairs. So for example, I would have invested and continue to invest in the US dollar, especially against the yen. We've seen today that it made a new yearly high. It started the year at 115, now it's at 133 or something, with the potential to go even higher, considering that, as George said, Japan rates are going to stay at 0.25, and US rates could easily go higher than 2.5%. So I have access also into what our traders do, and some of the most successful traders that I've seen in our brokerage are the ones who are buying the dollar and selling the yen. But personally, what I would also invest in is the real estate market. But you need to be very careful to make sure that any mortgage that you will get and negotiate with the bank is not going to be a variable interest one. So you want to make sure that you get a fixed interest on your investments if you're going to be borrowing money from the bank. And lastly, agricultural commodities and futures. So that's where I would put my money.
George, I've got a flexible mortgage, George, so go easy on it. Flexible mortgage is going up as we speak.
Don't worry about it. You live in Dubai. Don't worry about it. You could have you could have a... there's two parts. One is the geopolitical front. So if we get any good news, geopolitical-wise speaking, equities would definitely get a boost. So insofar as that, the smaller is the better. I think in Dubai, I mentioned the SLYV ETF, which is the S&P 600 small cap. If you look what has happened since then, everything else has crashed. That has gone nowhere. So it's held its own. And the reason why it's held its own is because the forward PE of the companies comprising that index is down to 12, which is like a multi-decade low. So at the end of the day, fundamentals do matter. So I would be buying, if we see some geopolitical,
Improvement.
yes, improvement, I would be definitely buying equities, and the smaller the better. Now that's one part. The second part is, of course, is what will happen with monetary policy. If central banks insist on raising rates, if the Fed insists on its current trajectory, I think we're going to have many problems worldwide, and the one problem we're going to have is the dollar. Now the dollar is basically killing just about every emerging market out there. It's not just emerging markets, killing a lot of, it's hurting a lot the global economy and growth for many reasons. I'm very sure that the Fed is aware of this. I am not exactly sure what is in the back of their mind in their pursuing this policy, but they are aware that as long as the dollar stays very strong, it's very bad for the global economy. And when the global economy is bad, even the US, it might be this, might be that, but even they're not going really to do good if the global economy tanks. So, like I said, the second component would be monetary policy. If they back down, then we would probably say full equities. I think commodities will probably come down a lot then. Also, a lot of the geopolitical stuff has to do with China and the US. So I think we're going to get some good news there. I think the Chinese are not crazy. They've reiterated that, they want to fix everything. And even the US wants to fix with China, be on better conditions.
That sounds positive.
Huh? That would be a very big positive. So, yes, I would invest Chinese stocks because right now they're trading for scrap, especially some of the big names. Didi is trading for scrap right now.
Maybe buy a house in Hong Kong instead of London.
No, I didn't say houses. No, do not. I would be selling Hong Kong real estate and buying Chinese shares. That, yeah, but buying in Hong Kong, no.
James, what do you think? Would you buy a flat in London?
I couldn't afford a flat in London, first of all. If you borrowed some money. Yeah. If I could borrow some money off someone who wasn't a bank, then I would buy a flat in London. But I mean, I think one of those things comes back to David mentioned oil markets. Oil markets have that potential to continuously play that range that it sits in at the moment, capping at kind of almost 125, a little bit higher than that. And playing that to $100 on the downside. Now that plays into the commodity currency play. The commodity currency play along with the Canadian economy is particularly positive. Even though rates will continue to go higher there, the economy is in a slightly better place than a lot of others. And New Zealand is an interesting one because the way the New Zealand dollar tends to behave is a bit strange because it tends to, when oil goes up, it gets bunched into the commodity-based currency basket and kind of moves in that same oil-based move with other commodity-based currencies. But of course, none of the commodities throughout New Zealand are mainly agricultural. They're not energy-based. So as soon as there is an issue with on the other side with oil falling, it doesn't tend to fall the same way. So it's kind of bunched in on the positive side and not bunched in on the negative side, which is a bit of an anomaly, So there are opportunities out there, and yeah, if you can afford a flat in London, buy a flat in London.
I'm surprised these guys. I don't think they mentioned Bitcoin yet. Have they mentioned Bitcoin? No one recommended Bitcoin. Bitcoin's
That's because none of us know anything about it.
Huh?
We're too old-fashioned for anything.
Yeah, it looks like I need a bit, crypto guys. But so I want to cover cryptos quickly. Crypto economy.
Cryptos are one of the greatest inventions of the 21st century as a way of separating idiots from their cash. And I know a lot of people might not like that.
I agree.
But I mean, it's absolutely fascinating. And there are great stories of you buy X here and you make 10X. But most people aren't doing that. Most people, unfortunately, it's sucking in a bunch of people who wouldn't normally trade, and because their next door neighbor bought Ether at wherever, or Dogecoin, whenever, they all come in. So I think it's an odd market, the cryptos. I think Bitcoin actually is a buy down here.
George
So to be a bit less
loves you here
cynical,
with this comment. He agrees completely, I can see.
Bitcoin-
But your grandchildren in the future will hate this comment that you guys said, that I think they're all going to be investors in cryptos in 20, 30 years.
Do you reckon?
No?
Okay.
This is not going to go away, is
I
it?
think no. I don't know if it will go away. Do you know? I really don't know because I don't care about it from a technology point of view. To me, it's just another market. It goes up, it goes down, it goes sideways. Yeah. So I think Bitcoin having halved from where it was in November is perhaps a trade. Whether Bitcoin and Ethereum or whatever is going to change the world for us, I've still to be convinced of that. But as a market, it's an interesting one down here if all the lunatics come back in again and push it back to 60,000.
Who's the youngest here? Who's the youngest? I think James. James, yeah,
That doesn't happen very often.
yeah, you trained this young man, so let's see what he says. Like 20 years ago, you trained him, right?
He's actually my son, but we haven't done the DNA test.
So James,
Yeah,
you're in your 30s. Come on, tell us something about the crypto and the economy.
Clinging on to my 30s with the skin of my teeth. But yeah, I mean, look, I think that's what we're all looking at from a crypto point of view here. That not looking at the technology, looking at it from a market, looking at it from traders, and looking at it from that point of view. Of course, you have to look at the fact that these markets, however, whatever we think about them, whether they're going to change the world or not, they're insane. The movements are insane, of course. So we know you have to have deep pockets to trade them. So, it's not that you can agree or disagree. The markets are mad. Yes, Bitcoin is at a low point at the moment, and it of course can bounce from this lower point. It can also go to zero. It goes back to the same situation as markets can go up and down. Just Bitcoin can do it a lot faster and take a lot more people's money with it as it does it, and that's the other side. Yeah, of course, there's alternative coins. There's coins coming out of everything. Everything has a coin these days. There's a coin somewhere, and I'm not saying in any way whatsoever that Bitcoin won't change the world necessarily. But from a trading point of view, as David says, don't care about the technology. I want to know where it's going to. If I'm trying to predict where it's going to move, I look at the fact that it's off however many percent, and usually when something's off that much, it tends to come back. Markets are cyclical, including Bitcoin.
Yeah. George, before you criticize, El Salvador's president chose Bitcoin as their national currency.
Yeah,
I know
I told you they're going to lose money back then. I think it was 55,000.
Oh yeah, they lost half the money, right?
Yeah. Listen, I don't think Bitcoin or crypto is going to change anything on planet Earth. Okay. I don't think it's going to do anything better anybody, and I think everything's going to turn to Luna. So, funny thing about Luna, you said everything could go down from trading. So, my son, the first day Luna goes from 100 to, I don't know, 3, 4, whatever it was. He says, "Dad, we should buy Luna." I said, "What the fuck is Luna?" He says, "It's this, and this." So I go on my thing, I said, "Okay, well, why should I buy it? What is this thing, He says, "Well, because it's down 97%. Anyway, that's the first day. Then went down another 97%, and then another 97%. And then the thing is that if you don't know why you're buying something, if you're buying, and this applies to everything, if you're buying something simply on price action, you're basically gambling. And when you gamble, you will have, your returns will be that of a gambler. Okay, so when you gamble, you will have gambling returns. And as we know what happens, okay, one person out of 33 will win on, what do you call it? The one,
roulette.
On roulette, yeah. But the other 32 people are going
I
to
always
lose.
win.
God bless you. I never won in my life. But what I'm trying to say is that, yes, you're going to hear a story that this guy won in crypto, or in anything, it doesn't matter. Yes, that might be true, but the other 32 people are going to lose. So if you don't know if you don't know the fundamentals of anything, I'm talking about anything. It could be commodity, it could be stock, it could be crypto, I don't care. You have to understand what the fundamentals are, what might drive the price, the balance sheet, this, that, whatever. Okay, if you don't know that and you're basically acting on price, I call that gambling, and I cannot participate in something
James,
like
you were going to say?
Yeah, it's just it's that old situation of if you're hearing about an investment and you're acting on an investment from the guy in the pub, the guy in the bar, or the guy at the golf course, you've usually missed out. And you could get lucky and get on it at the right time. But history would say, if you're hearing about it in the bar, you've probably missed the boat.
I thought in England you guys used to say all the good ideas are happening in pubs and stuff like that. But yeah, maybe...
In my experience, absolutely no good things come out of that.
Nicholas, I hope
Yes.
you have a great pro-Bitcoin
Look,
thing.
I mean, it depends on from which aspect you looked at cryptocurrencies and Bitcoin in general. So if you look at it from a speculative aspect, yes, of course, the price swings are crazy, and it doesn't really make any sense to, bet the bank on it. So it's clearly used as a speculative asset for now. But if I'm not mistaken, I think the market cap for the whole crypto industry is about 1.5 trillion. Compare that to gold, which is 10 trillion. We are still too early for that market to be less volatile. So for it to have any use and be used by any national country such as El Salvador, you need to combat the volatility first. So when it comes to El Salvador, I think that play didn't really work out well yet so far. Not because of the difference in the price that El Salvador invested in, but because of the adoption in general of the people in that country. They don't trust it yet, and the volatility is a huge reason for that. Once you get to control volatility in some way, then we will see more and more adoption, because at the end of the day, it's just a means of an exchange, just like any other form of money.
So we're going to see some adoption, in your opinion. I think we're out of time, so anyone has questions, you got 10 seconds to raise your hand and ask a question about Bitcoin, gold, anything? Anyone got a question for these guys? Back there.
So you spoke about, Hi. So you spoke about the traditional point of view that gold is a safe haven for investors. What about NFTs and alternative asset classes?
Not you, Dave.
Actually, I should take back what I said about crypto being a brilliant invention to separate people from their money, because I forgot about NFTs.
That's
so
even
yeah,
worse.
JPEGs of monkeys, an even better way. So I'm not convinced.
I'm going to let Nicholas take this one. Do you think NFTs could...
Again, NFTs does have some usage, let's say, in giving owners of certain memorabilia or artists some ownership rights and the ability to get some money by distributing that
the
to
board
the wider...
monkey, right? The board monkey guy.
Yes, but I'm not
they
a
got
believer.
stolen, I heard.
I'm not a believer either in either the metaverse or the NFT marketplace. I still need a lot of convincing.
Okay. We need someone to convince these guys. Okay, thanks everyone. That's it. Thank you.